All right, which camp are you in? A couple rate cuts later this year, none at all?
I think there will be rate cuts. The Fed has some room now to cut, right? Because inflation has actually fallen. And the inflation expectations may look to start to fall too if we really get to a point of de-escalation of this trade war, that tariffs are not going to be as high. So as expectations fall, the Fed has room, but the timing seems to be challenged because of the uncertainty. And I think this is what the market's still waiting for. But I think the Fed is in a position to cut, so it likely will follow through in the later year.
You know, I think we're going to have to watch the Fed fund futures today, because after that post from the president, I don't know what that means for the trade negotiation situation or the environment right now, and what that means for the pause, the 3-month pause. So the possibility of Fed cuts, what does that mean for bond yields? Bond yields seem to have a really big impact on the markets for most of this year. How do you see it impacting the long bond, the 30-year, and also the 10-year?
Yeah, I think we're going to go back to what we had last fall. If we cut rates and the economy is already recovering from this April shock, then recovery is going to continue and can maybe accelerate as you cut rates. So yields should go a bit higher from here as opposed to lower, at least in the initial phase. I think we're going to test probably close to the 5% in the 10-year, simply because this economy is picking up, and as the Fed gives it a little push, then, yeah, that will happen.
Let me ask you about the 2-year, because really the Fed has the biggest influence on the 2-year. Right now it's at 3.95, kind of in the neighborhood to be competition for equities. As we see a more dovish potential coming out of the Fed, I guess that's the way to put it, does that lower the yield on the 2-year and kind of reduce some of that pressure from the bond market on the equity market?
I think that's right. I mean, I think that the 2 years reflecting where the Fed will be the next 2 years. And so it could go a little lower in yield as the Fed cuts rates. So I think, yes, that would relieve the pressure. And I think the markets take the rate cut as good news, as Wallace says, because the Fed's doing it because inflation is going to go down. But if you push the economy with a rate cut, then you're going to get the long end going higher. So I think it's a steeper yield curve, too, as a result of that action by the Fed.